What's good, superstars? Back with another living out of my brokerage account video. It's been a while, but I've been making some changes. This is going to be a beefy update. You're going to see it right off the bat here with my cash flow diagram that I got made in Canva. People are asking me, where'd you make that cash flow diagram? This is Canva, and it's pretty simple. If you use the tools and all that stuff that they got, they do the arrows for you automatically depending on what direction you want them. Very simple if you're looking to make your own type of cash flow diagram, just so you can understand. Like, I recommend it for people who are doing their own investing journey, just to lay out their plan and make sure that they know exactly what their plan is, and then stick to the plan. Because when we veer off the track, that's when things especially start to become a problem. So anyway, here's my cash flow diagram. The way that it works right now, I am not living 100% out of my brokerage, but I think that's going to change in the very near term, with some top ups from my RRSP. I'm in Canada. I have a registered retirement savings plan that I ballooned maybe a little too early. I got a lot of time left in my career still, so I think I can afford to do some moving around and pay some taxes on it. It is what it is, but I think at the end I'll have a better system and a better portfolio built up with a little bit more flexibility than having it all in the RRSP. It did help with some tax savings early on, but I think that we can offset that with some of the gains that we've had in the RRSP. So anyway, paycheck, deposit. So let's say I make $1,000 in a paycheck. I will deposit a portion of that, and whatever portion I deposit, 60% is going into my growth or margin account, and 40% is going into my high yield, which is now my high yield / leap / XEQT fund account. I'm going to explain this. All right. We're going to get into that further detail. But anyway, the way that the funnels work is still the same. Anything that the TFSA produces will be reinvested into the TFSA. Any open space in the margin account through growth, we'll try and use some put credit spreads to gain some extra premium to help grow the account and funnel it that way. All bills will be paid out of the margin account. So if I'm investing $1,000, anywhere between $700 to $1,000 will be used on bills. Early on with a smaller account, basically, if you invest anything more than 50%, if you withdraw anything more than 50% of what you deposit, your margin or your equity is going to drop. That's just the way that it works. If you want 50% equity, you need to take out only 50% of whatever you deposit. If you take out more than that, then your equity will drop. And you can see here, I want to maintain 50% or more equity. So I have to make sure that I remove 50% or less of what I deposit. That's just how it works. I'm doing 70% because I'm hoping the other 20% is made up by my premiums, my dividends, and my growth, right? So in my margin. So that's what we're hoping. We can make up that 20%, but up to 100%. If I have a really good month, I could probably withdraw 100% and still maintain my 50% equity. Any other money that I come across, if it's gifted money, or if there's money that you find in your couch, like that stuff, those are other deposits. Those go directly to pay down margin. That helps with equity. I don't need to invest it. It's just going directly to pay down margin. So any extra money goes in to pay down margin. Now let's show you the changes that we made to the portfolio. So the percentages are the same. When I'm reinvesting my dividends, it's still going to be into high yield funds at the same breakdown that I have before. I'm going to explain the change that I made as well. The growth stays the same. 60% is going into growth. It's still the same breakdown. We're growing it. We're getting close to 50-50 now. If you remember, we started it was 40-60. So we've made 10% back on the growth side, which is good. Here's my growth account. It's the same. I have not touched. I'm not selling anything in growth. I'm not taking any taxable capital gains / losses on this account. Whatever I buy. This list is only going to grow in terms of holdings. Right now I have 30 holdings, and I'm sure that I'll have more. Recently I've added palladium. I have platinum in there. I have silver. I have gold. I want to add the basket of them all in there. I just want to have a bunch of materials, but that's going to be offset by my Bitcoin as my other commodity, IBIT. So I'm going to try and grow this position. I'm going to go through and update all these targets and see if we can go through that one another video. But anyway, right now the account is up 9.7%. We started this in September, so not too bad for the growth portfolio. The problem becomes when we get into the income portfolio, the high yielding portfolio. We've had significant drawdown, 12% down, and this was also the bigger portfolio at the beginning. So that means that we are down overall, which is this number right here, $641. We're trying to make it up. Our equity is still looking pretty good, but we have not taken out our 70% yet. So we're at 53% equity. Margin available 3,000, margin used 10,000, and the portfolio total is 2,200 or 22,000. So we have a little bit of cash from some of the moves that we made earlier on. So the way this is going to work now, I've deleted a bunch. I've gotten rid of a lot of funds. I used to have 50, I now have 26. So I'm almost taking away 50%. Probably will get rid of some more over time here, but these ones here we're doing all right. I took a capital loss on January 14th of $1,300 Canadian. So current value is zero. We zero that out. The cash that I got from that, I put into a leaps for TQQQ, which is a very, very, very volatile, aggressive play. Not recommended. Nobody do this. I'm a guy in my car. I'm sitting in my car outside my daughter's dance recital right now, or practice, and I'm filming this for you guys because I wanted to give you guys this update. It's huge. It's a huge update. But anyway, I ended up, I'm down on this right now, 5%. It's very, very volatile. I just bought it. And the markets have gone down, so this goes down. But this is a long-term time horizon. It's January 15th, 2027. I do hope that technology and the NASDAQ will be higher in a year from now. So that is my bet. It's a long leap. It's a call option that I bought for January 15th, 2027 at $48.50. I paid $16.45 per share for the contract, and the current price is $15.58, or that's the mid price. They give you an average. So we're down right now, and I have to update that number by myself because my sheet does not draw options, which is kind of annoying. The rest of it, I have a little bit in cash, and I have a bunch in XEQT, which is a world fund. It's Canadian fund. As you can see in the red writing, any red writing is Canadian funds. The reason I did this is because I had a split, and I didn't want to take until they give me the Norbis Gambit. I'm not going to be converting as much of my Canadian to US Canadian. I'm losing so much. I'm losing 1.5% every time that I do that. So I'm going to hold off, and I'm going to keep my Canadian funds in XEQT. Can't do options with them, and try and grow this. If I really find a play that I need to do, I will do the conversion for the 1.5%. But for now, I'm going to try and grow my TQQQ. If we make like 10-15%, maybe sell it and then roll it out longer, and try and grow the leaps that way. But the rest of them are all high yielders. Anything that these produce, it's going to be significantly less. I was making around $300 a month on the other ones. Now that I've cut that in half, probably get around half of the return, if not less, because I'm sure a lot of the funds I cut were like Bitcoin and those types of funds that were higher yielding. So we'll see what we end up with at the end of the month, or next month. Even if it's $100, that $100 will be reinvested into the high yielders. XEQT will continue to grow, hopefully. Right now it's flat because we just bought it, and the cash position, as I find opportunity, I'll put it into something else. But we got to turn this around. We can't be down 12.5% on this one. So 26 holdings from 50 holdings, pretty big deal. We don't have any insurance running right now, just because I've explained this before. The flash crash is something that I'm not interested in betting so much insurance money on. If the market goes down slowly, which is a lot of times it does, where it takes maybe a month or a couple weeks, then that flash crash option insurance is not going to make a dent, especially as the portfolio grows here, unless I have a lot of insurance on. And then I'm going to be spending money, and then, I mean, it just, unless it's a very unique event has to happen where it's like a 1, 2, 3 day event that just really kills the market. It can't be over extended period of time, because it's just, it won't work that way. So that's something that we got to take a look at. So, now that you know how I've changed up, these are my put credit spreads that I have on. That's a good thing I show you. So ARM, the first one I did, I ended up positive. $127 was the result of my premium. And then I did a Pepsi play, and Pepsi just kept going down, and I lost on that one. I had to close it out, $186. So the net is $59 down on the margin. So it's nothing crazy. But right now we got 2 on for Apple and Netflix. They've both been beat up pretty well. And we're running those until we're going to check them. We're checking on them on their 21 DTE. I did, I think, 45 days to expiry for those ones. I might even start doing like 30 days to expiry on my next ones. But the further out you go, a little bit more premium that there is. And some of these safer stocks, it's harder to draw premiums. But we're playing around. I'm not going to lie to you. My put credit spreads are a learning experience, and I'm enjoying doing it because I have a limited risk. Whatever my spread is here, so 103 to 108, that would be a $5 spread. So my max risk is $500 minus whatever my premium was, so 361 on that one. This one here, I did 2 of them at $5 spread, so I had $1,000 risk, and that's why I closed it out at 320, because I didn't want to lose more than that. and I'm just limiting my risk or my losses. Apple, I did a $5 spread, so I have $500 risk, and same thing for, oh no, Netflix, I did $7. I think that was just how it worked. There wasn't a $5 option, so I did $7. So I have a $700 risk. But if I lose max, I'm gonna be down $575. So I'm comfortable with those types of losses. Put credit spreads, I have a video on if you want to check that out as well. So continuing on, this is my projection. So I'm changing up the way this works. I mentioned earlier, like maybe we're gonna do fully living out of the brokerage sooner than we thought, and this is why. So we are currently at month 5 of this experiment. We are at January. We're at 53% equity right now. You can see I've only taken out 38% of what I've deposited, so I do have some room to take out, and I will max that to at least 70% this month. This month, I'm just going to be sticking to whatever was happening before because we did a lot of changes, and I want there to be a clean start to the month. So next month will be when I do all of the full changes. But anyway, swapped to high yield and leaps in the TFSA, so I showed that. So now it's both of them, and I also have XEQT. I should put XEQT in there as well because that was the fund I chose. The reason I chose that is I have another fund, which is VFV, that I've been investing any money that I need to save for taxes when I withdraw from RRSP. And what do you mean you withdraw from RRSP? Like I said, I mentioned I ballooned my RRSP because I was heavily investing into it to help with tax benefits early on, but I'm realizing I don't really need that many tax benefits now. I'd rather have the cash flow. So if I take out $4,000 a month in RRSP to top up, and why 4,000? Because if I'm investing, let's say $10,000 a month, and I'm withdrawing 70%, that's $7,000. How do I get to 50% equity? I need to add another 4,000. If that 4,000 comes from the RRSP, and we do that for however many months this is, it looks like around 12, 13 months. It might be more than that. Then at that point, we will start to have dividends. Let's say that I convert my entire TFSA at that point. This is tracking what would happen if my TFSA was making 20% yield, and that would be my blended, like I'd be trying to get that. So let's say that I'm trying to get to 40% of what I'm depositing, because then I can just put that, instead of taking from my RSP, I can start taking from the dividends. So at this point here, which is month 20, which would be April of next year, so about a year and a quarter, we would start to convert 100% of our TFSA value, which is around $100,000, into high yielders, and hopefully make $4,000 a month. Take that 4,000, invest it into the strategy, meaning 60% growth, 40% high yield. Then that would help with the equity, and you can see the equity stables out here, right? So our equity is going down slightly here, and that's because we have inflation accounted for. But we are also adding the 4,000. So as you see here, it just keeps going up now after we do the 4,000, and that's because the dividends are growing as well, right? So it helps to accelerate the equity buyback, which we can stay around 50% and grow the portfolio more, or we can start to eat away at the equity, and slowly we'll get to 100%. Looks like in 7 years, portfolio will be 1.5 million. We will have no debt, and we would have around $25,000 in dividends. So that's pretty crazy. I think this is something I want to do. I think the long-term goal of taking out the 4,000 a month might end up being worth it. We deal with the tax consequences when they come after the first year, but I mean, even then, after the first year, if we have $100,000 in the TFSA, 250,000 total, and 120,000 in margin, and we're netting $4,000 a month, I think we're in a good position, and we start to figure it out from there. So, yeah, I mean, you guys let me know what you think. This is a little bit of a different way about thinking things. Here you can see this is the 40% of what I'm depositing. I can change these numbers around, but this month so far I've only deposited $2,400, and then I have $900 that I've withdrew, but I will be withdrawing, like I said, 70%. Will I, at the end of this month, depending how much I invest, will I take the 40% out of the RRSP and invest it? Maybe. We'll see where the equity's at. If I don't need to, that's the other thing. Like this 4,000 might not be 4,000, might be less. If we have a lot of growth and the equity is growing and I don't need to put 4,000, I'm not going to. So this is just a placeholder right now, and I'm really happy with like how this is projecting out. I mean, it looks like things are going to be growing pretty quickly here. We have like, let's say 10,000. We'd be matching deposits by year 3, which is crazy in terms of dividends. And then we would also be starting to grow the equity, you would hope. Right now I have very conservative 7% growth on both of them. That's the other thing though. Once we get to this year one, month 20, I will have to change the growth rate of the leaps account to 0, because if we're going to be getting these distributions, I don't want to be also expecting growth from that account, which is a mistake that I've made earlier in this series. So right up to here, basically we're accurate. And moving forward from here, I have to change the formula, maybe make another column and say after phase 1 and then phase 2 percentage, and then it will automatically change based off of what phase it's in, and I'll have to make it pull from here. But I think I'm gonna like a circular reference from Excel. That's why I didn't do it the first time. So yeah, that's how it's gonna work. I think I'm pretty confident that this is what I'm going to be doing moving forward. This is why I haven't had a video in quite a while. It was just this whole week I spent rearranging things, and I'm happy to be where I'm at right now. End of the week down, not a big deal. I'm gonna be dollar cost averaging because we're gonna be investing every single week, and variable amounts. I just put 10,000 as a placeholder. It might be 12,000. It might be 8,000. We'll see what happens. We'll see what's comfortable at the time, and maybe we'll just try and match it up with what the expenses are. If we spend $8,000 that month, maybe we invest $8,000. We're gonna start to realize a pattern of how much we're investing, and trying to live out of the brokerage as soon as next month. So this might be ended up being next month. The problem is, if it's not $7,000 that we're withdrawing, this number might be going up as well, right? If I'm going to be withdrawing 10 grand, then I would have to invest more than 10 grand to be able to offset and have a proper equity. So it's going to be a trial and error still, and we're going to take it 1 month at a time, but this is the idea. So you guys let me know what you think. Do you enjoy this change? Do you think I did the right change adding these things? I'm changing it kind of into a growth/leap strategy for the first phase to help grow up the portfolio, and then at the same time we're tracking with this column what would be the dividends at a 20% yield, so I don't have to actually take in those dividends. I understand I could be reinvesting those dividends and snowballing that account, but I ran the whole thing through ChatGPT. I did some calculations, and it seems like it's not as, like, I'm still compounding the account. If the account is growing at, like, say 5% a month or whatever, it's compounding on top of whatever it already grew. So it's kind of the same deal if I'm using the growth funds. And the leaps, I'm hoping, could help accelerate it. If it doesn't work out, we can always switch back. But let's see what happens. And I'm curious to see what you guys think. So guys, if you're new here, please hit the subscribe button. I'm trying to grow the channel with unique ideas like this. Smash the thumbs up button so more people can see it. And we'll see you in the next one. I love you. Bye.